Welcome to the Commercial Real Estate Report. The mission of the show here is really to empower you to build generational wealth with real estate. I'm your host, Chris Berg, head of business development with Abernathy Holdings. We build Class A self-storage sites in California, Arizona, and soon to be beyond. I'm really excited to share the story of our guest today. I had a chance to meet him up in Napa at the California Self-Storage Association event back in May. He's built a beautiful self-storage portfolio, about 43 sites in California, Washington, Oregon, New Jersey, Illinois. He is the CEO of Trojan Storage. He says, fight on. I say, fear the tree. Brett Henry. Brett, great to see you, man.
Hey, good to see you too, Chris. Thanks for having me.
I really appreciate you doing this. So first off, let's just start with your story. You've been the CEO now or with Trojan Storage for, I believe, 17 years. How did you end up in the self-storage asset class?
You know what? I wanted to be a real estate developer out of college when I graduated in 2000, and I met some guys that started in storage back in the mid-late 70s, and worked in their portfolio for about 6 or 7 years. Kind of started entry level and worked my way up to really running the company and reporting to the three of them. And it was a good environment for me to kind of learn and operate and kind of see what self-storage was. And that kind of turned my attention from the opportunity and in really managing self-storage, which was a great asset, produced a lot of cash, but really had a lot of mom and pops and kind of unprofessionally managed sites that still made a lot of money. And so we thought there was an opportunity to go in and buy assets that were devalued, improve their operations, and then therefore improve their value.
So you're in college, want to be a developer, you get into self-storage. What kept you in it? Was it just the returns? You're like, oh my gosh, because I mean, it was very much an unsung asset class at that time, right? And now you see all the capital that's going into it. It's just been incredible, the changes.
More than anything, I was having fun. I remember a lot of my friends, early 20s, work was kind of a grind, and I really enjoyed it. We took over really the portfolio was kind of challenging when I got there. They had a lot of deferred maintenance. They had a lot of in-place people that had been there for 10, 15, 20 years. There was 12 sites in Southern California, and 6 of the 12 managers were stealing pretty significant sums of money. And so I'm kind of a forensic person by nature. I like to kind of find things that are wrong. I've always liked puzzles. And so I really got an opportunity to kind of rebuild the company. We pretty much replaced the entire group. We started looking at storage differently. The owners started investing in their properties. At that point, everybody was using double truck advertising in the yellow pages, these $50, $60, $70,000 ads, and no one was tracking their success. No one had web pages. And so, kind of being a kid, I was able to go in and boastfully tell them everything I thought was wrong. And it allowed me to really go in and on someone else's dime, really learn what worked and what didn't. And so the answer to the question is, I really was having a good time. The owners were treating me well. I was getting promotions, and I was being paid pretty well for a 25, 26-year-old kid. And it was I've known my business partner my whole life. And so it was, kind of in those conversations I had with him of what I did there, that we realized when we started looking around that this company, with some of the challenges they were facing, because it was very profitable, wasn't really the exception to the rule. It really was the rule in self-storage. There was no third-party management, generally speaking. People had these assets, and they made so much money that people held them, and they just didn't do much with them. And so I was, more than anything, I was having fun, and it changed my mind. I really didn't want to be a developer anymore. I really wanted to kind of just buy mom and pop facilities and just operate them well. And so it kind of changed my outlook of what I want to do in real estate, because I found operations to be a kind of an entertaining, way to work.
So you were going on doing more acquisitions. I guess, gosh, I've got so many questions for you. When did you realize, being in this asset class, like, okay, maybe not now, but the institutional capital is coming?
Yeah, I didn't see that coming for a minute, because when we bought some of our assets for $5 and $6 million, our thought was that they would double in value, from 6 million to 12 million. We didn't think to go from 6 million to 20 million or 22 million or 23 million. And so In 2016, we started having conversations with some brokers of kind of what we thought the value of the assets were. And it was kind of then that we realized that we acquired all these assets for $75 million and that we thought the value was over 200 million. And so, my partner and I own the majority of Trojan Storage. We own more today than we did, but we always owned, about 65, 70% of all the Trojan Storage assets. And so once we realized how much equity was there, we really felt like it would put us in a position to sell. And the challenge for, my opinion is the challenge for the big money was they just couldn't get into the space, at $5 and $6 million purchases with only, 45,000 storage facilities out there. There just wasn't an opportunity to make a big splash. And so we realized that we could put our portfolio on for a couple $100 million. We watched iStorage do it. We watched a couple other groups kind of do it. And so it was kind of at that point that we realized storage was changing. And for us, that's when we realized we really couldn't be a mom and pop buyer anymore. It was about 2017, 2018, because of just how much money was coming into the space. So we decided to really take our sale and all our profits, and John and I put it all into really development. We bought almost $75 million worth of land in 2017, 2018 using our money. And then, went through the entitlement process from, Los Angeles to San Jose to areas of the Portland, a little bit in Seattle, and really decided that, areas that we fundamentally could never buy into were really where we needed to build. And so that's really kind of how the company transitioned post-sale. Was we now had a pretty good resume. We had good relationships with banks, and we had the ability to kind of go in with our own money and entitle things and kind of change our business model. And that's really when we realized that the change really was institutional capital coming in. That now storages we're going to start hitting 60, 70, 80 million dollars, and we never predicted that in 2007 and 8 when we started.
So walk us through your strategy there. Because to deploy $75 million, was it 12, 18 months maybe? Not an easy feat. And so are you guys buy and hold forever right now as you develop these? And are you looking at IRRs? Are you just looking for places? Like what's your strategy as you were going in and making these acquisitions of the land?
Yeah, I think for us, when we looked at overall strategy, we really wanted to be in areas that were in high demand, meaning that we felt like there was a big population, 300, 400, 500,000 people in 3 to 5 miles, which is not a lot of places in the country, where fundamentally it was hard to buy storage because they were doing so well and they were so valuable. We're really not a bond buyer on storage. If something's 92% occupied at market rents, then there's nothing left for us to do. That purchases for everybody else. That we just can't make those. And so I think for us, looking at, we really don't need to sell again. That's not to say we probably won't in the future, but we want to be places that in an environment like today, where today is different than it was 2 years ago, we still feel like there's a lot of demand and that we can run our business and weather little storms that come through, because I think we're in one right now. And you can feel the difference between something that's in Los Angeles versus something that's in a more tertiary market that's got 100,000 people in 5 miles or 50,000 people in 5 miles. For us, the LA stuff has just always been easier to run. And so that was really our driving factor, and our belief that storage was going to become more and more difficult to develop over the next 5 to 10 to 15 years, which I think we've seen. When we were done building our Camarillo site, the city implemented a moratorium. Thousand Oaks has one. The city of Commerce, where we built one, has one. The city of Campbell, where we built, has a moratorium. And so we think the cities are going to be more and more difficult. And so now's the time to really put the storage in. And that was our thought in 16, 17, 18, and 19. And land wasn't as expensive as it was today. Interest rates were lower, and then construction costs were, feels like, half. And so that's kind of why we slowed down a little bit, just because everything seems to be working against you right now versus what it was 4 or 5 years ago when we were buying land.
So I want to come back to that in a moment, but let's stick to your strategy as you're deploying the $75 million and you're looking at the land. I guess, what was the top three metrics you were focused on when you'd say, okay, we're going to buy that piece?
Yeah, I think the first was, what's the population? Again, what's the metrics of how much storage is available per person in the market, and is the population over probably 400,000 people in that 5 mile trade? We wanted to be, in generally speaking, pretty big metros where there was a lot of people. The second was we really wanted to feel rent rates were going to be in excess of $2 by the time we built the asset. That wasn't always true, but it takes as much energy to run something that's making 75 cents a foot as it does something that's making $2 a foot. And so we don't do a lot of third party management. And so we really we don't really have desires of being 500 or 600 storage facilities. We really want to be a lot of 125,000 square foot storages that can make $3 or $4 million a year versus having 50 storages that each make 500 grand. And so, the dollar value of what we thought those could bring in were probably number two. And then number three, just the difficulty, the barriers to entering those markets. What was the likelihood something else was coming in after us? Which is, there's always going to be some, but our toughest project is probably the Portland site, and that's because we followed a couple sites in, and then a couple sites followed us in, and you've got us and 4 other good operators, essentially trying to fill up storage. And it's challenging when you've got 5 lease ups in a market that's got a good amount of storage. And so we don't really have those problems in Los Angeles as much. And that was probably the 3 biggest drivers were, lots of people, low supply, pretty good dollar per foot. And then what's the odds something else is coming in after us?
That's, you just read my mind. I was going to ask, how much of your strategy is defensive and how much are you going in and looking at other plots of land that potentially could have self-storage built in it? And are you talking to the city about zoning, and how much of your strategy is defensive as well?
Yeah, I mean, we've walked away from a lot of developments that someone entitled something that in upstate New York, where someone converted a part of a mall into a storage facility. That concerned us when cities allow retail to flip that quickly, or when they're allowing office space to flip into storage. The challenge starts to become, storage is a great asset class because its supply is constrained. If it ever became Amazon, where you could just drop millions of square feet in within a year or two into a market, that market would have problems. And so, for us, when we see that there's an opportunity for that, or there's a lot of vacant land around that could go into storage, we're much more careful. That doesn't mean we haven't been willing to buy in areas. Most of the stuff that's kind of more, I'll call tertiary for me. We have a great site in Salem that's done very, very well. I probably wouldn't have built it, but we bought it at a really good basis and, super happy with it. Would I have built a project in Salem? No, it wasn't for us. We really want to keep our developments are treated differently than our acquisitions. And so, but yeah, from a defensive standpoint, I think being in this for so long, you realize that, you watched Denver and, 6 or 7 or 8 years ago, just was such a great market. Everybody developed into it. It got crushed, and it's now returned because I think fundamentally it's a good market. But everybody built into it. And so that's something we're always really, really careful of. And probably why we've stayed out of some of the redder states, because we felt like, we can't control how much is going to come in.
So well said. Thank you, Brett. I mean, that's one of the things when I came back out here to California to do what we're doing and build self-storage. A lot of people, like, I was at ISS in Vegas and people were laughing at me like, what are you doing going into California? That's impossible. We were like, that's kind of the point. We've got a great JV. And he says, guys, you want the high barrier to entry. And speaking to the defensive piece, I think I shared with you in Napa, we saw a beautiful piece of dirt next to your site in Elk Grove on Bighorn Boulevard. Right. And we were like, no, because you build beautiful stuff. I mean, your stuff is fantastic. And we were just like, you know what? We're not going to fight Brett. He's got a good thing going. Let him have it. So you mentioned underwriting, and you said, hey, Chris, we underwrite it so that when we open, it's at $2. And I was curious, do you typically underwrite with a rate, 2 or 3 years in advance, or are you underwriting based on the rate today?
I always underwrite at today's rate. And then it probably gets a little more frustrating to some of our analysts and people that work on that, because I always discount the heck out of years 1, 2, 3, and 4, because if I don't really care what they think the rate's going to be in I mean, I care, but when it comes to underwriting, they have to use what's today's rate, what are we going to go in at, and what do we really think the market's doing. And then during lease up, we usually knock off 25 to 30% of the rate in year 1. In year 2, year 3, we drop that down to 20 to 25%, and then year 4 it comes down to 10. But we want to be really careful. We've always said we would rather miss a great deal than do a bad one. And that's not to say we haven't had a project that hasn't gone the way we wanted, but generally speaking, I've done what you just said, that we've looked at something, we liked it, and then we realized someone was building something that we liked down the road, and we didn't really want to go in and be the guy with 2 sites, that are each 100,000 trying to lease up. And so, but you have to expect that. I think it's easier to manage a lease up when you're stabilized than it is that you're leasing up. And so we always look at what's today, and that's become challenging. 2 years ago, I had to tell all our underwriters that you can't just look at the asking rate. Just because Extra Space is renting a 10 by 10 in San Bernardino for $300, I remember that was $80 5 years ago. And so I don't think that's their effective rate today. And likewise today, when you see an 80 or 90 or $100 rate, in a good market from Extra Space, nor do I think that's the market today. I think it's the opposite. I think they're getting, we look at historically what we think they're doing and how they're pumping rates and what we think their mind is, and we then try to underwrite to that. And so 2 years ago was probably harder, because we felt like not every market in the world was $3 a foot like everybody thought it was. And then today it's kind of the opposite, right? How long is this path going to last, where people are renting units at 75% of what they think the unit should rent for, and they're going to just give rent increases every 5 or 6 months. So, but no, we've always tailored to being more conservative, and I think some of that is it's my money, it's my partner's money. We raised some from people that have been active with us for almost 17 years, and we've never lost anybody's money. And so my group, John and I, we don't take any acquisition fees, we don't take development fees, we don't take asset management fees. We take a lot of the equity, but we don't make money unless all of our investors make money. So if I go and build something, we don't charge 5 or 6 or 7% to build it. It's just not what we've done. And so for me, it only matters if there's going to be equity at the end. And so that's always the focus, which means you have to underwrite conservatively. That any deal works on any underwriting numbers. So if people push too hard because they love a deal, sometimes you can get burnt because they were so focused on getting it done. They just, what if I just change this a little bit, it works. And so we've always been kind of mindful of that.
If you're comfortable disclosing, I'd love to hear what kind of returns you're working out with your investors. And so when you go in to do a development, like for us, we're looking at a certain IRR for ourselves. We're looking at a certain IRR for our JV partner. Are you basing a lot of your decisions based on that IRR? Are you more buy and hold forever, refi? We'll pay our investors through that. Like, what's your investment strategy?
Yeah, so we don't really we don't ever manage refis. We've been very successful with being able to pull money out for people. We don't ever model that. We've always looked at, can we make an investor between 18 and 22%, on their money on average, an IRR of 15, 16, 17. Can we do that on an annual basis? And because we have so much of the equity, if we're able to model where it works for the investor, it always works for John and I. So we've always felt like if we can just make enough on their money and that they're really happy and satisfied, and I think almost everybody reinvests every year, then it's we're always taken care of because we're really the back end. So we got to make sure there's enough money on the front end. So we've always given people preferred return. Usually it's been about 8% of the cash that comes out every year, and then we split the equity off. And so we always tell people to prepare. We're going to hold these things for a long time, but we also tell everybody we're advantageous. We had no desire to sell in 2015, and in 2016 we sold. We just responsibly, we couldn't hold assets that in our mind that were worth 75 million, or that we paid 75 million for, that we ended up selling for almost 250. and it just seemed like the responsible thing to do at that point. And so, and it helped investors, it helped us, everybody was really excited. And so I wouldn't sell today because of market conditions, but in 4 or 5 years, if we received an offer that was, we thought really, really strong, we would look at it. So I think our investors know that because they almost all of them were involved in the sale, and but we always underwrite to 10 years, but we have no clauses in any of our operating agreements to sell. We can kind of make that decision as it comes up.
And are you taking on any new investors?
Not really.
Okay.
Not really. We've done a little bit of, our investor base is very, very relationship based. And so we've never advertised, we've never done anything like that. And so we've had some new people come in, but for the most part, we're constrained because I don't think we've ever put a budget out and said, hey, let's do $200 million worth of stuff this year. We just take things as they come, and if it hits our target and we feel safe, we feel good about it. And John and I have always invested the most money of in any of our funds. We do a fund every year, and so we're always the largest investor into that fund. And so as long as we're willing to put our money into it, we feel good about it. They've typically averaged about 125 million to 150 million a year. Last year was the first year we didn't do a fund in, I don't know, 7 or 8 years. That was the first year we haven't bought a property in a decade. And so, we only do stuff if we think it makes sense. And if it doesn't, we have no mandate to go spend money. So no, historically, we really haven't taken on a lot of new money over the last 3 or 4 years.
So you kind of answered my question. So it sounds like you guys are doing more of a fund. There's no SPVs or special purpose vehicles, just straight fund.
Yeah, well, each asset's owned in an SPE, and then the fund owns 100% of that SPE, and then all the investors and us are all at the fund level. And so that's generally how they're handled.
You just mentioned that last year was the first year in 10 years you didn't buy a property. Why? What was happening? I mean, I know the rates, but like what was going on internally? You're like, we're not doing anything.
Yeah, sure. When we built our Glendale, California, and Commerce facilities, Glendale is a 3-story, 250,000 gross square foot building. It sits, this first floor is 15 feet. It's a really, really cool build. I think we spent $62 a foot on the hard costs. And I think today that would be 110. And then you realize that we did a takeout loan on that asset at 3.5% for 10 years. And the rental rates we projected in 2017 have been like, we're at year 10 of our projections, just a couple years into opening. And so, we always said that, with everything we built in 17, 18, and 19, the rental rates we predicted, the interest rates we predicted, the construction costs we predicted, everything went in our favor. And then last year, really in mid 22, we realized there were some changes coming. And so we realized that construction costs were running. We were starting to be concerned. Interest rates were running. In August, my COO and I sat down. I remember mid-August of 22 and said, August feels different. It felt like April and May of 22 were the two best self-storage months I've ever seen in my entire life. Mm-hmm. Our Commerce facility, our Glendale facility, I think they rented 700 units in 2 months combined. That would fill up facilities. And by July, it kind of had tailored a little bit. And then in August, all of a sudden, it just felt like the wind stopped. And so we called around and everyone told us they thought seasonality back, but it felt different. And that really was the start of the 6 and 7% mortgage rates for homes. And demand went down. And so I think we looked at it and said, we've got all these buildings that we're starting construction on, that we finished construction on, that we're in lease up. Let's take a breath, because construction costs are now so expensive. We don't know where interest rates are going, and rental rates we're a little nervous about because they're at peaks. And so we're looking at all these projects and everyone's valuing their land off an extra space 10 by 10 that's $350, and we're not sure that's the market. And so we really did take a breath. It's the first time holistically we've walked out away from probably 8 escrows, where we had spent money in titling, because it didn't make sense to us anymore. And so it was a nice breath. I did more vacations in 23 than I think I ever have in my life. I think our acquisitions people were a little bored. Our operations teams just kind of went and let them really focus on operating. And we knew, this year we've been opening a new site almost every month since February, and that will continue through, August, September. And so it was just kind of a nice break, but we wanted to see what was going on. And now we're kind of dipping back in. We're probably going to buy some things this year and next year. But now at least we feel like we've kind of rebalanced that everyone doesn't expect all rental rates to be $3 a foot, and everyone doesn't expect, interest rates to be down in the next, 3 or 4 months. And, construction costs are moving in a little bit, but, they also may be here to stay for a while.
Yeah, I mean, especially here in LA, I know you are really focused on LA, at least when we spoke in Napa, and you think about, the World Cup 2026, the Olympics, and there's going to be a lot of contractors that are going to be busy, thus, increasing the rates, I would presume. So you've been in the business for a long time. You've kind of answered my question, the last one, because you've got a great gut feel on it. What's your gut tell you about today? I don't know if I want to add this in or not, but I will. What's your gut tell you today? But then also when you look at the data per Yardi, like Yardi shows a dramatic decline in supply coming online in 27, 28, probably even 29. Does that get you excited to go, hey guys, we got to start deploying some capital and get back in the development game?
You know what? It feels just like 2013, 2014, and 2015, where storage was really tough in 2010, 11, and 12. And then in 13, it felt like you were towards the bottom of, well, at least you understood what was happening. And we also then had this big pause because nobody built in 11, 12, 13, and 14. And it let everybody fill up their buildings, get some rental rate growth, and everyone took a breath before the next wave of development hit. And so I think it's good. Like I always thought that was really, I think everyone thinks that was really good for us as operators. And so I think that's kind of where we are again, that select projects are going to get built, that everything we see on Radius or other Yardi that say they're going to, that they're being built, we really go look at because we doubt they're going to get built. That doesn't mean some aren't, but I think it'll be good because I think we're going to see a transition of our customer. I think we're not going to be as strongly correlated, hopefully, to housing at a point, because I think we're going to see more and more renters over the next 3, 5, 10 years. I think that's going to be more and more people, and in our mind, more renters is probably good for business. I think renters move more often than homeowners, and so I think this year is going to be challenging again. It's better than last year. I think next year will be better than this year, but I still think those are tough when you correlate them to 19 and 20 and 21. And then I think we'll get back to some normality of, everyone's in the low 90s and you've got some good rental growth of, 4, 5, 6%. And you're not feeling as much pressure as I think everyone's feeling right this minute. So I think it'll be a good thing. It's probably like the breath we all need.
Do you, based on your experience, do you think rental rates are at the bottom or close to? Or there's more room for them to decline?
I think there's going to be a little bit more pain in areas that are oversupplied. I think that just makes sense because the one challenge of self-storage has always been that the first thing you do is you drop your asking rate. That's always our tool, and we got to mitigate that because we can give them a rent increase 4 or 5 or 6, 7, 8 months later, and so. I think the places that don't begin to stabilize will continue to feel some. It's hard, even with rent increases. It's hard to grow if you're renting new units at half off of what your customer is already paying. I think the more stabilized areas are really going to continue to see pretty good growth next year, and I think everyone's going to feel pretty good in another couple of years. That's my guess. And that's why, but to answer your question, I do think we're towards, generally speaking, I think this is as bad as it has been. And I can't imagine it's going to get much worse than this.
So you mentioned 2021, there was a lot of new money coming in the space back then. The rates were through the roof. We know the refis are coming up here in the next, year or two, maybe 3. Are you seeing, is your team seeing a lot more deals maybe that are entitled or C of O? And people are just concerned about the refi situation?
Yeah, I mean, we're seeing projects that probably aren't going to get started because of who the person entitling the dirt is. They just don't have sometimes the resources, and it's not, it's hard for me to get bank debt right now. It's not like it was 2 years ago, and so I also think you're going to come up against people that maybe opened their buildings at the wrong time and anticipated selling, and now that they can't sell, I think they're going to be in a position of having to either raise more capital to pay down the loan, assuming the lender will extend them, or sell the asset for whatever they can get for the asset. So I think there may be some more forced sales in some of the merchant builders over the next 12 to 18 months. And I think it makes it complicated with the pressure on rates right now. I don't see people pushing. Deals are getting done, but I think they're getting done at cap rates that people aren't used to, and I don't think as many people are buying future revenue as the driver of their offer. I think they're looking at what it's doing today and being more modest of what it'll do tomorrow. So I think there's going to be some challenges for certain types of buyers. I don't think the guy who's owned his site for 10 years and has reasonable debt is in any. I think they're just making a little less cash than they're used to. And so I don't think those guys are going anywhere unless there's a death in the family, or there's something that occurs that makes them sell.
I'm curious, have you had a chance to look at the site in Inglewood that's right next to the Intuit Center? Does that ring a bell to you at all? That's 6 or 7 stories.
Yeah, I looked at it months and months and months ago.
I was going to say, so what did you like about it, and what prevented you from saying yes?
I mean, I think the construction costs.
Yeah. Okay.
I mean, I think that's probably the biggest challenge on that, and I think that's their issue. It's a small piece of land when there was small footprints and tall buildings drive up per foot, and so that was the biggest issue. But Inglewood's a great city. Obviously, it's I can see the Intuit Center from my office. It'd be great, but that was always a challenge.
Yeah. Okay. I wanted to see how you process the site, because the same with us. You mentioned Salem a while ago was a surprise site for you, and then you mentioned, hey, Chris, but there've been some sites in the past that we thought were going to be great and they just weren't. So I'm curious, as you think about your portfolio, what has been the most common metrics that have made sites succeed? And then let's talk about maybe some of the sites that didn't perform as well as you'd thought. What happened there to prevent them from performing as well as you'd hoped?
Yeah, I generally speaking, I think for us, the properties where our basis was just really, really low has always been made the site easy. And so our Salem asset, we bought it at, I don't know, $85 a foot for essentially brand new construction. It's hard to go wrong on those. That thing's fluctuated a lot over the years. Our occupancy goes to 93%, then down to 82, and then back up to 93. And for us, we've got a pretty low levered loan. It's less than 3%, and so it's hard to miss. The ones we did where we kind of did them a little later over the last few years, where you're trying to predict against what's the real rate and what's our extended interest rate going to be when we get a final loan on it. I think those have been sometimes more challenging, but there's nothing in our portfolio that's not, except for lease ups, that's not making money and profitable. The question is, does it make as much money as we want? Which has really been I think it's probably been to our more conservative nature of being willing to pass on deals that maybe we don't understand, or we don't know why they're being priced as high as they are, and not buying as many over the last few years as we used to.
One of the things you mentioned in Napa that I appreciate is you talked about, hey, Chris, we're just looking for places that are hard to build right now, that high barrier to entry. So I want you to sort of walk us through your strategy, the process. I think you mentioned the site in Calabasas that I think you said an escrow or entitlements for 5 years. Is that sound accurate? And so just walk us, because that just sounds arduous, laborious, and like HE double hockey sticks to most developers.
Yeah, Calabasas has probably been the most extreme. There's been unfortunately lots of roadblocks that have come up to get that site. It starts construction hopefully in the next few months. But it'll have been a 4 year from the time we actually bought the land. And I mean, John and I are fortunate that we were able to just acquire the land and sit on it and kind of work it through its process. I don't know if I would feel as good about it if it was anywhere else besides Calabasas. It's a really strong market. There's probably not a lot more that's going to come into that in a 5 mile radius. But that's what we sign up in LA. When someone tells us it's an 18-month CUP, we always assume it's a 36-month. And so the challenge then for us becomes how far can we get a seller to go, and how much risk are we willing to take? Because we acquired our Commerce facility before we had the entitlement, and we acquired the Calabasas before we had the entitlement. We probably 50% of our sites we close on with a feeling that we're going to be okay in the entitlement. Now we always have the backup of land that we could sell it if it doesn't work out. But that's one of the things in LA that we've just had to do to get projects done, is being willing to make sure we understand what the process is and is it going to happen. And we've been wrong before. And as as a developer, you can walk away from 400 or 500 grand when you go through an entitlement process and it doesn't work.
So what's your backup strategy to sell the land? Do you have other industrial guys that you can sell it to, or what's your strategy there?
Yeah, I mean, the Calabasas one's always unique because we've had all kinds of I probably get calls on that land more than any land out there from all different groups. And so I have a backup entitlement of that asset. So I do have the ability to build something there right now that I would build. It's just not what I want. And so we've really been re-entitling that project. So that one's going to be storage. And the question was always, it was going to be my storage or what was entitled before me. But at this point, we're pretty close to having it all wrapped up. We're getting our CDs signed off on pretty quickly. But yeah, I mean, that would always be our backup of what we think. We've kind of factored that into. We assume that if we bought the land for storage, that there's a likelihood that we're going to sell the land for less than we paid for it. And that's just part of our entitlement cost.
And so are you doing like a dual entitlement journey with the city? You said you got an entitlement backup?
So it's entitled for storage. We were just changing the entitlement. So it already went through the whole process, which is what's made it a little more frustrating, because our changes weren't in our mind super material, but it was material enough to require a new process. So we do have the ability to go back and do something else, but that's not our desire.
Okay. And Brett, I want to be respectful for your time. Like, I'm so into this conversation. I look and I'm like, oh, okay, we're beyond what I thought we were going to do. So are you comfortable time-wise for a couple more minutes?
I got a couple more minutes.
Okay, thank you. I really appreciate it. So just a few more questions. And one, as I see some of your sites are getting into boat and RV, what's your assessment of boat and RV? Has it been good to your business? And secondly, a lot of people I talk to right now that have been involved in self-storage for a long time say, hey, boat and RV is what self-storage was 25 years ago. Do you agree?
I'm definitely not. I mean, I've owned a lot of boat and RV over the years. For us, like the Camarillo facility was more of a mandate from the city. They wanted it, and so we provided it. It was just kind of part of the entitlement. We avoid it if we can. When you have excess land and you kind of don't want to, or you want to do things in a couple of phases, I think it's just a great placeholder. But it's starting to, in certain areas, I mean, it's really starting to see a substantial growth in just what people are willing to pay for those. As it's harder to put them on the street these days, and what are you going to do with them? And there's not as much of it. We're involved in a boat and RV up in Agua Dulce that has done. We don't run that one. It's a partner of mine, and they've done better than we ever thought they would do. It's been a great business. It's all boat and RV. They've been wildly successful, and so I know some people are starting to pursue it more. The challenge in my mind has always been how people look at it, because the cash flow is different because you don't have the asset of the building. And so for lenders and for different things, there's been some challenges when it's solely boat and RV. So I've always cautioned people that if you want to do boat and RV, if you can't do a little bit of storage to kind of put them together to have people look at them as a self-storage facility, I think you're going to do better. So I don't know if it's the next self-storage. I think it's going to be successful. It probably is successful anywhere, meaning that you could probably put them in, and there's probably not an oversupplied market of boat and RV that I can think of. No matter where we've been, we had one in Colorado Springs that was, I don't know, it was like 12 acres of dirt attached to our storage facility that we happened to buy, and it was always 85% full. So, I do think it's a good business. I've always encouraged people to at least attach some storage to it, but I know people that are really pursuing it and done really, really well.
Nice. Again, to be respectful for your time, just a couple more questions here. So one, where do you see, or how do you see prop tech or AI impacting the self-storage business?
Yeah, I mean, we've been I'll kind of bifurcate those. We've been looking at different ways to manage our costs. So we've done some PTI door boss. We've done a lot of no key. We've done, I don't know, 7 or 8 buildings with no key. It's gone pretty well. It works, and so it's expensive, but it works. We're kind of looking at how can we manage these assets for people that are now more used to self-storage, where they don't need to be walked through everything. How do we get them to not come into our office, to do everything remotely or at their computer, go to our gate, go to their unit, and get access without needing somebody just waiting around for them? Because one of the hardest parts for us has always been a manager, who sits around and helps 5 or 6 customers all day, but has to sit in the office to do that. And so we're trying to find ways to bring that. So we launched our own call center at the end of last year that is kind of in its pilot, and it's taking pretty much all the Trojan Storage calls right now. And we're putting we've been building our own kiosks and working through that. We've also done an open tech kiosk, which has worked pretty well. And we bought our own. We bought a software company a couple of years ago, and we've been redoing that for the last 2 years, 3 years now. And so we're releasing that cloud version in the next month or two. It's done. It's just I've got 4 of my sites that are running it right now, and we just want to make sure it's all the way ready, because we're going to bring Trojan onto it. And then we've got some great competitors of mine that are also going to come on it. And so I think technology will become a very, very important part of what we're doing in storage. I think AI will start to disrupt how people price and what type of predicting our decisions before we can make them, taking some burden off. I know everyone has their algorithms and different things that they're doing, but I think once you really start to put some really smart AI kind of working alongside of our analysts and our different people, hopefully it can start to produce decisions faster than they can, and probably better than they can, and that way they can kind of supervise the process versus always trying to have to get all the entries going and analyze it and figure out what the right method is. So I think it's going to have a big movement in what we do, and could substantially change how we run our buildings. Public and extra space have really been a centralized operation for a long time. They still put a manager in, but that's not who they're relying on to run their sites. Their call centers, their locations, their branding, their SEO and SEM have really kind of pushed beyond. And so I think that's going to allow us to really have some benefits to start catching up to what they're doing.
Yeah. One of the things I'm really anxious to see with AI, have you seen the movie Moneyball?
Yeah.
Yeah. So I'm curious if AI starts to help people like yourself, where you've got a lot of data and you plug it into an AI and it starts to spit out, hey, you know what, you're focused on the wrong metric. This is actually what creates a successful site, and those kind of things. So it'll be interesting to see if that takes place. 2 more quick questions. One, what do you think are the biggest threats facing self-storage today and over the next decade?
Yeah, I mean, I think I don't see any big extra. I remember meeting with some of the guys at Clutter early on when they were going to disrupt storage, like Uber disrupted taxis, and I was not the only owner who saw problems in what they were doing, because I just don't think they understood our customer base. So I don't worry that there's going to be something that drives our demand away, that takes our demand, because movers have always been a part of what we do. But that's not, we're not movers for self storage. That's not what we do. I think one of the concerns is, the consolidation is going to continue. I think it's generally good for most of us, because I think that's going to what continues to drive value, and I'd rather compete against public and extra space than 5 or 6 mom and pops. So I'm not overly worried about what else is coming to compete with us. So I do worry that one of the challenges that most of us will have is, if as consolidation happens, it'll become more and more and more private equity, and that it'll continue to push out some of the rest of us. So that's probably something that happens over the next 5 or 10 or 15 years, and it maybe makes it hard to grow. But I think storage is in a really good position going forward for the next 10 years.
I was going to ask them, and I want to end on a good note. Where do you see the biggest opportunity? And if you want to use some of these variables I'm going to suggest here in a moment, great. If not, that's fine too. But you look at what's happening with onshoring. Do you see any opportunities maybe internationally, or even the demographic and tech trends in India? And then also there's this massive transfer of wealth over the next probably 10 to 20 years of $75 to $100 trillion from baby boomers to their heirs. I think that's going to bode well for our industry. So where do you see, and maybe it's a market you want to share, but the biggest opportunity in self-storage over the next 10 years?
Yeah, we have been asked here and there to do some offshore stuff. I've always been very cautious with that, because I don't think people always appreciate how different a self-storage market is that can border against a self-storage market. There's really micro businesses. The something in Santa Monica is very, very different than something in Burbank, or something in North Hills, or something in Calabasas. And so the way they operate, who their customers are, how they get business. And so, I think the opportunity is going to be that, like you said, as more and more of these, the consolidation is happening at all levels. There's a lot more guys with 30, 40, 50 storages today than there were 15 years ago, right? That made you really big, generally speaking, if you had 50 sites. Now it seems like you talk to anyone, they've got 25 or 30 sites. And so I think as that consolidation happens, I think we're going to see, values continue to appreciate. I think development is going to continue to be pretty strong for the next, 5, 6, 7 years. And then, I think the opportunity for those of us who, this isn't maybe a forever business. And that, I guess for me, it's kind of been a forever business at this point. I think it's good that more and more money, I think we're one of the best asset classes out there. And as the roll up continues, both on the micro level and at the REIT level, I think it's going to mean there's a lot more opportunity for us to cash out or sell or move some of our assets at probably price levels that we didn't expect. And so I think the storage world is great. I always tell people, I think the last couple of years have been hard. And if you compare that hard to what some of the other asset classes are facing, like we're still doing great.
Yeah.
It's just hard for us because it was so good in 21 and 22. So generally speaking, the reason we're developing is because we think the market looks great for the next 10 or 15 years. And there's going to be new entrants and more money and new competition. And we think that's just good for self-storage.
Brett, I cannot thank you enough for your time. As you can tell, I could be talking to you for hours. I want to be respectful. So
I appreciate that.
I want to give you the last word. Anything else you want to add or share that I haven't asked you?
No, I appreciate having me on. I think it's good for these conversations are great for self-storage, and appreciate what you're doing. And thanks for having me on.
Thank you very much. Again, Brett Henry, Trojan Storage. He says, fight on. I say, fear the tree. This is the Commercial Real Estate Report, empowering you to build generational wealth with real estate.